One is on the far right, and that is silver. The 8 largest traders are short 183 days, 182 or 183 days of world silver production. And as you and I talked off air before this interview started, that's 6 months of world silver production that commercial traders, the supply-demand fundamentals, everybody knows it now that there's been a structural physical deficit in silver for the last, this is the 4th year that it's been around. And the only reason that the price has not blown higher is because J.P. Morgan who owns, Ted said, is in physical possession of at least 1 billion ounces of physical silver, has been supplying this deficit all this time. And early in February, he figured that they dumped well over half of it in the market already in order to prevent the supply-demand fundamentals from showing up in the price. But this is ongoing. It is structural. There's no way it can be. It's no way it can be fixed by mine supply. And even if the price went to say $200 an ounce tomorrow, the deficit will remain. And it'll take 5-10 years for mining production to catch up to that. So as long as J.P. Morgan is supplying the physical silver to fill the deficit, they can play with the price all they want, and that's what they've been doing. So I'm like everybody else. I'm all in on silver. I've got my physical, I got my shares, and I'm just waiting for this supply-demand fundamental thing to kick in, as was Ted and as everybody. So that's the situation in the physical side. Now, in the paper market, there's the COMEX futures market, there's the LME and the Shanghai and the Hong Kong and all these exchanges. But the fact of the matter is, it doesn't make any difference what the commodity is. There's silver, gold, platinum, palladium, crude oil, natural gas, a whole raft of physical commodities. They're all traded on the COMEX, and that's where the price is set. And Ted would go off on deep end on this, and he was absolutely correct. It doesn't matter what's going on in London. It is a totally opaque market, completely opaque. You can't see anything in there, and all the statistics they give you are so out of date and so distorted, you don't know what's going on there. But the price, doesn't matter how many millions of ounces they sell or trade, it doesn't affect the price. Let me give you an example of that, Danigan. India this year has purchased, 120 million ounces of silver over a 3-month period. I think that's something or that order. Now, that's 120 million ounces is 24,000 COMEX contracts. Let me ask you this question. If you went into the COMEX and placed a long order for 24,000 contracts, what would that do to the price besides drive it to the moon and stars? Of course, India's, the people who were buying in India were smarter than that. They went and bought it on the LME, where it didn't affect the price at all. They just went there and said, okay, fine, we need 24,000 contracts or 130 million ounces. And they took it off the market, took delivery of it, physical delivery of the silver, and the price didn't move an inch. So that tells you right there that it matters not what's going on in Shanghai or the LME. Now, it might someday, some of the things they do, especially in Shanghai, do spill over into the COMEX, but the price is set in the COMEX futures market. And that is the way it's been forever. And at some point, with the BRICS thing and the rise of China and stuff like that, it may change over to the Shanghai Gold Exchange. But at the moment, we're still under the thumb of the American empire. And their grip on commodity prices is the same as their grip on air power and air superiority and sea superiority and the dollar index. And, when you're an empire, you control everything. It's like the British Empire. They controlled everything. They control everything now. And the commodities, including gold and silver, are just one more aspect that they have under their umbrella that they keep controlling. Now, okay, so if they're listening to this interview, they can just scroll down the page there and you'll see it. It's very simple. These are the physical, I think there's 13, I'm not going to count them, but I think these are the physical commodities that are traded in the COMEX futures market on a daily basis. And the chart is extremely simple. The the commitment traders report shows the concentrated short positions of the 4 largest traders and the 8 largest traders in every physically traded commodity on the COMEX, and they're all represented on this chart. And the obvious one is on the far right, and that is silver. The 8 largest traders are short 183 days, I think it's 182 or 183 days of world silver production. And as you and I talked off air before this interview started, that's 6 months of world silver production that commercial traders, all the exclusive commercial traders, are short in the COMEX futures market. The 4 traders, that's the red bar, the green bar is the 8, and the red bar is the 4, the largest 4. The 4 largest traders are short, 120 days. So the 5 through 8 traders are short the difference between the red bar and the green bar. And that's the same for all of the commodities going right down the list. And as you correctly pointed out, the short positions of the 4 largest traders dominate the big 8 short positions in all the commodities, no exceptions to that rule. And you'll notice, make careful note of the fact that gold, silver, platinum, and palladium are nailed to the right of the chart, and with the odd exception of cocoa once in a while for other reasons, it does sneak in there. But those silver has been nailed to the right-hand side of that chart for the last 45 years, except for a couple of weeks in 2008 when palladium was the hot number of $3,000 an ounce, and silver got bumped out of there for 1 or 2 weeks. But silver has the largest concentrated short position of any physical commodity in the history of planet Earth. And until that changes, nothing changes. Take a look at crude oil, which is on the far left of that chart. I think the big 4 are short 4 days world of oil production, and the big 4 are short 2 days. Okay, let me ask you this question: if you could take the short position in silver of 182 days and stick it on the price of crude oil, what would it be? Make me $5 a barrel, $3 a barrel. The short position of the size that's on silver on crude oil would crush the price, crush it, of any commodity, okay? And it's been this way for 50 years. And like Ted correctly pointed out, if that short position didn't exist, or it was far more modest, let's say it was down around where soybean oil or copper is, copper's a good example because they're both industrial metals, then the price of silver would be something well north of $100 an ounce. Keith Neumeyer's 3-digit silver price. So that short position, and in silver most prominently, and of course platinum is right behind it with gold and palladium, if those short positions were normal like the rest of the commodities, their prices would be absolutely sky high compared to they are today. And it's this commitment of traders report concentrated short position that Ted's been going on about ever since he started in this business back in 1985. And even before that, when he was getting the commitment of traders report once a month by mail. Now we get it every week. So we're getting fairly recent data, but it's this concentrated short position, which has always been there, that is what's keeping the silver price in the dirt. And it's those 8 traders, all of which work in collusion. The latest COT report, if people are interested, let me just bring this up here. I got it right here in front of me. In silver, these 8 traders are short about 55% of the entire open interest in silver. 55%. So it doesn't make any difference what the other 45% of the traders do that are long or short in this commodity. The big 8, all working in collusion, as Ted points out, control the price. And in gold, it's even far worse. Let me just bring it up here. In gold, 8 traders are short north of 60% of the total open interest in silver and gold, which is right now the open interest is 444,000 contracts. That's about 270,000 contracts that the big 8 are short, and they're all banks, all investment houses, and they're all sitting on the price. And as Ted has pointed out for decades, until that changes, nothing changes.